Well, hey everyone, welcome to another episode of Pocket Pundits. I'm very excited to get into the topic that we have for you today. We're going to talk about the economy, we're going to talk about government spending, but also the markets, new technologies like AI, where we're seeing things headed. So it's going to be a great conversation today, I'm sure of it. I'm going to introduce our guest to you here in a moment, but before I do that, I want to give a big shout out to Silicon Slopes, an organization here in the Salt Lake City area. We're members of at Cottonwood. Fantastic group of people, and we thank them for letting us use their studio today and give us a chance to really put a nice show on for you. So let me give a little bit of background on First Trust. First Trust Portfolios has been a long-term partner of ours, whether it's investment opportunities, cutting-edge research, and really some interesting insights into what's going on in the economy, the markets, new technologies, and so forth. It's a great organization, and we're very lucky to have Strider Elas here with us today, their senior economist, to talk about what's going on. So Strider, thanks for joining me today.
Hey, thank you, Matt. It's a real pleasure to be with you.
Yeah, looking forward to it. So let's dive in an area that we're getting a lot of questions about right now, right? The geopolitical landscape.
Sure.
So there's obviously a lot going on, but fill us in. What are you seeing? What are you guys thinking? What do you think's on the horizon as far as that goes?
Sure. I think especially since Trump's been elected, a lot of the geopolitical tensions that we've been seeing are actually starting to get less intense. But one of the big ones that he's intensifying, I would say, is that with trade wars and tariffs, and kind of very similar to his playbook back in 2018 that he put into place with China and other countries. And I think ultimately what I hope we see from this is it's used as a tool more than just a blatant tariff across the board. But we have heard recently in the last couple of days that he does want to do blanket tariffs across the board, but reciprocal tariffs. So if you have a tariff on us and it's higher than what we have on you, then we're going to raise our tariffs to get in line with you. If you want to lower your tariffs, then we'll lower our tariffs, so on and so forth. And so what I hope really comes from this is that we do see tariffs come down substantially. Will that happen? That's to be seen. But I really think the way that Trump looks at this is that businesses in the United States are not getting their fair share of business internationally because of higher tariffs abroad. That makes it harder for them to compete. And I agree with that? I don't know if I necessarily agree with that. One of my all-time favorite economists is 𝗏𝗏 Bastiat. He was a French economist, philosopher back in the 1800s, and he was able to make things so simple, and he's a big free trade guy. And one of the things that I've always taken from him is really view everything from the point of the consumer. And when you think about what tariffs do, is that they are a tax on the consumer. Ultimately, no matter if Trump says that another country is going to be paying for it or not, it does most likely fall to the consumer with a higher price of goods for what they're getting if they're having extra tariffs put on those. But I think Trump's whole viewpoint here really is he looks at it from the producer, and he says, look, if you look at where we are right now, our simple average tariff, so tariffs across the board, our average is about 3.3% on goods coming into our country. Well, if you look at all of our 10 biggest trading partners, every single one of them has higher simple average tariffs than we do. So I think his point is either you lower your tariffs to get more in line with where we are, or we're going to raise our tariffs to get more in line with you. And the reality is that we've seen this playbook. It happened back in 2018, and what we saw is actually China lowered their tariffs, simple average tariff, from about 9.8%, which had been stuck at for a very long period of time, down to 2018 to 7.5%, and it's been there since. And really every single country that we did a trade agreement with back when he was president the first time has lower simple average tariffs today. The interesting one to me is actually India. Since he was last president, they've actually raised their tariffs across the board substantially, now up to about 17% on average across the board. So I wouldn't be surprised if we see Trump go after India in a way too. But all of this to me does impact supply chains. And so it should cause some havoc globally. and cause supply chains to start to move elsewhere, as they've already been doing. But all in all, I think if the end game is that we see lower tariffs across the board, then I think it will be worth it.
So it sounds like your view is this is maybe a negotiating tactic, which Trump has obviously done in the past, but two, maybe a recalibration of the global landscape from a cost and tariff standpoint. You mentioned supply chains. Do you think during this process, Strider, some of that supply chain will shift, say, back to the United States? We'll have more manufacturing, things like that?
Yeah, I think that's Trump's ultimate goal, right? To bring more manufacturing back to the United States. And I think it's happening. I think it will happen, especially if costs are higher around the world because of extra tariffs, and it makes U.S. more competitive. But I don't know if that's always necessarily the best solution, because ultimately you want consumers to be able to get the highest quality good for the lowest price. But I think one thing that you have been seeing is ever since Trump was president last time, was when he started to implement tariffs, supply chains did realize, and companies realized, we can't have all of our eggs in one basket. We can't have all of our manufacturing just in China, because what if these tariffs go up even higher? So they started to spread out their supply chains, whether it was moving to other Southeast Asian countries, or to India, or to Mexico, to Canada, to Brazil. I mean, we saw supply chains start to broaden, and then COVID hit, and supply chains really started to say, well, we really can't have all of our eggs in one basket. Companies said, we can't do this anymore. So we've been seeing supply chains start to broaden and really start to move out of China to other countries. And it's interesting, if you look at the import data coming in for the United States in terms of what we import, and you look over the last 5 years, our imports into the United States are at record highs, and they're up about 25%. But what's fascinating is if you look at imports from China, they're actually down over that 5-year period by about 21%. So who's made up the difference? Well, a lot of it's been Canada, it's been Mexico, it's been Vietnam, it's been India, it's been all these other countries where we're starting to see supply chains broaden out. And I understand some of it was, instead of moving it from China to the United States, China to Vietnam or somewhere else, to Taiwan, and then over to the United States, whatever. But it's definitely not all of it. And so China's really been hit hard, I'd say, through this. And I think that's going to continue. So the United States holds a lot of power here.
Interesting. Going back to, you said earlier, the consumer, the health of the consumer. It sounds to me like you're not convinced that the tariffs longer term will be bad for the consumer. Is that a fair statement?
Well, I would say if the tariffs stay in long term, it does raise prices, which means that consumers will have less purchasing power, and which means lower living standards. If you can't buy as much with the money that you have, you're going to see lower living standards with that. It's not so much that it's going to be inflationary. I think it would be more of a one-time hit to prices, but still, we're paying for prices that are higher over time, or goods, excuse me, that are higher in price than they were. That's a negative for the consumer. But can the consumer handle it today? I would say this is another crack in the economy that could move us more towards a slowdown, I believe, especially on the lower end, where the consumer's already been devastated by inflation over the last 4 years. Adding further price increases, and it's not across the board, obviously, but to certain goods and services would impact them in a negative fashion.
Yeah, it makes a lot of sense. Well, let's since we're talking about the economy and the impact, let's talk about that a little bit more. What are you seeing trend-wise? We've seen some indications at Cottonwood, for example, where actually growth was picking up. Had a good Q4 GDP number. Consumers financially still look okay. Obviously, we still have high prices, higher inflation. Strider, what are you seeing? I mean, do you think this trend's going to continue? Do you think we're going to slow down? Maybe contrarily pick up speed?
Yeah, I think we are going to see a slowdown throughout this year. And I would have said it. A lot of people say, "Was that political?" It's not. It has nothing to do with politics, really. It has everything to do with why we're in the situation. Why have we seen such rapid growth over the last couple of years? And so much of that, I believe, comes down to those policy decisions that were made back in 2020 really with the shutdowns, cutting interest rates to zero, providing liquidity to basically any sector that needing it, quantitative easing, and all of the stimulus that entered the economy. I mean, trillions of dollars of new government spending occurred over this period of time, and that's caused a temporary boost to the economy. And we think this is a year where that's starting to run out, and that we're now going to start to feel some of the impacts from those policy decisions to the negative side. You can't grow yourself to prosperity through government spending. It's just not possible. Eventually, you have to pay the price. And we paid some of that price, obviously, through higher inflation. But I think the massive amount of deficit spending we've seen over the last couple of years, where we've been running $2 trillion deficits, as a share of GDP, 6 to 7% of GDP. I mean, we've never really seen that outside of a recession or outside of a wartime environment. And so it's the most irresponsible fiscal policy that we have seen in a long period of time. And so I think that's starting to change, where whether Department of Government Efficiency, and I'm sure we'll get into that, is able to cut spending or not, we're not going to be able to spend at the continued levels that we've been spending at for the foreseeable future. It's just not going to be a possibility with the state of where things are. And so for all that combined, I think we will see a slowdown this year in the economy as those policies really start to wear off. And I think that's out of consensus, obviously, and with that, I think we'll see some downside pressure to the economy and to the markets. Maybe a recession, maybe not, but I think a slowdown nonetheless.
So do you, as it relates to government spending, fiscal policy, we've been on this pathway, I think, based on what you're saying, is for too much for too long, right?
Yeah.
Without getting too political, do you think the Trump administration or the changeover politically has what's changed that tone or wave, or do you think it would have happened, say, regardless of a changeover in the administration?
Well, I think it would have happened to some degree regardless of the administration, just because it's needed. But is it going to be accelerated because of President Trump? Definitely. And it wasn't just Democrats that got us into this mess. It was Republicans, too. I mean, it doesn't matter if you're a Democrat or Republican. Spending has just always continued to grow and
Right.
grow and grow. And really the issue is, as a share of GDP, it has grown tremendously. If you look back to 1950, spending as a share of GDP has averaged around 19.5%. Revenues as a share of GDP have averaged around 17.5% of GDP. So that's why we always have a deficit. But the reality is, right now, we're bringing in revenues around 17.5% of GDP, but spending is around 24% of GDP. And it was well above that. So the issue is really not on the revenue side. It's completely on the spending side. And that's something that just has to be dealt with.
Sure. We mentioned the Department of Government Efficiency, so maybe we can talk about that for a minute.
Oh, sure.
Obviously, the ranges of cutting, or I think on the low side, $1 trillion up to $2 trillion in spending cuts. What do you think's realistic at this point?
Sure. I mean, I am all for a smaller government. I think it's needed. The only way government spends money is by either borrowing it or taxing it from the private sector. So if you have a bigger government, they're taking more from the private sector. You have a less vibrant economy. The smaller the government we can get, the better off I think we truly will be. Is there areas to cut? Sure. Is there fraud? Sure. But I don't think it's going to be near the amount that they believe that they're going to find. And the real issue for me, when you look at where things are today, is that 87% of government spending today is made up of basically mandatory payments to either individuals for transfer reasons, or it's net interest payments on our debt, defense spending. I'd put in that mandatory category. So about 87% of spending is mandatory. So that only leaves you with about 13% that you could really cut into significantly, and even cutting into that would be an uphill battle. So, and the reality is, if you cut all 13% tomorrow, let's just say, those mandatory programs are on automatic growth trajectories where within 4 years we would have made up completely for that. So if you really want to get serious about cutting government spending, you do have to go into these mandatory programs and figure out ways to make them far, far more efficient. I think if anybody can do it, it'll be Elon Musk. But I think another cautionary tale, though, about this is if you think back to the 1980s and you think about when Reagan was president, in 1982, he wanted to do very much the same thing that Donald Trump has done with bringing in Elon Musk. And instead, Reagan brought in a guy named Peter Grace, who was the CEO at that time of W.R. Grace. And Peter Grace was a big fiscal conservative, and Reagan really tasked him with this job of figuring out ways to cut government spending. It was called the Grace Commission. I'm sure many people remember that. And over the next 18 months, he, along with about 160 other business executives, just combed through government, figuring out everything that could possibly be cut. And they came back to Reagan and to Congress about 18 months later, and they had an actual book that it was a small book. I actually have a copy of it. It's a great read. But they came back and they said, hey, these are what we found, and we have about 2,500 recommendations of ways to cut spending. And we believe if you follow these, we could cut spending by $424 billion over the next 3 years. I mean, that's significant money back in the 1980s, obviously, right?
Yeah.
And they said if we do this, by the year 2000, we believe that our debt will be about $2.5 trillion outstanding. If we don't do these, we think it's going to be more around 10, 11, 12 trillion dollars. And so Congress looked at this and they said, wow, this is amazing. This is great. And they didn't do anything. They didn't make any of the cuts. They made a small amount, but very little of the cuts actually happened. And so what I'm concerned about is that Elon Musk will find lots of things that need to be cut, and then it will be brought to Congress again, and they'll just kind of throw it to the side. I think the real difference this time around, which I hope he doesn't squander, is that he has X.com available to him, or X, Twitter, that he's able to post everything that they're finding and show, look, here's government fraud, here's waste, here's a program that's paying out, $1 million for whatever, and to show the public, the taxpayers, where their money's actually going. If there's enough uproar about what's going on, I think it's going to be very, very hard for Congress this time around to say, even with special interests, to say, well, I can't vote against this because if I vote against this, I mean, the public knows that I'm voting against this, and is it worth giving up my special interest to please the public to be able to be elected again? I think for a lot of them, it's going to be yes, that's going to be the case.
Yeah, it's very interesting. Obviously, it's a different environment than it was in the 80s, especially with the advent of social media.
Big
and
time.
Elon is, I think, the number one. He puts out the most content on X in particular.
I feel like that's all I read. Yeah, I feel like that's all I read about now on Twitter. But yeah, it's so. I would just say, long story short, I am very excited about the Department of Government Efficiency. I think they're going to find a lot. But I think the reality from what people are currently expecting, $1 trillion or $2 trillion in cuts, just for the way government's built today with how much is mandatory, it's going to be very hard. It's going to be a huge uphill battle. Even if they froze government spending at the current levels, I look at that as a win. And if they can make things way more transparent where we know where spending's going, that would be a win too. But again, all of it is an uphill battle, but I'm glad they're trying to tackle it for sure.
So I think the last time we had a surplus was in the late 90s. Is that correct? I mean,
yeah, it was under Clinton.
Do you think that's realistic?
To get a surplus, I don't, and I think that's what they're kind of pushing for now is, hey, we're going to find all this stuff. We're going to be able to have a surplus. I think it'll be even hard for them to go back to spending in 2019 before we had COVID, where spending skyrocketed. I mean, even if we could just go back to 2019 levels, that would be massive. I would be very surprised if we saw a surplus in the next 20, 30 years. If we did, it'd be incredible, and we'd be going in a really good direction with fiscal policy if that did happen. But I think, again, with the amount of people retiring and how Medicaid and Medicare and Social Security are growing, it would just be almost impossible.
Yeah, I would think we'd have to have a commensurate increase in economic growth to go along with that, right? To kind of grow us out of some of that spending some of those spending burdens, so to speak.
Yeah, and reality is if you, and again, it's still an uphill battle, but if you could just figure out a way to freeze spending, which again is not an easy thing to do, but if you just froze spending at current levels and spent that way for the next 7 years, which I think spending's already bloated, you should be able to figure out a way to do that. If somehow they're able to just figure that out, within 7 years, if the economy just continued to grow at about 2% and we had about 2% inflation over that period of time and revenues came in at their historical average of 17.5%, we'd see a balanced budget within 7 years. So it's possible. I just don't think it's probable.
Yeah. Well, that's fascinating. I want to shift gears a little bit.
Sure.
Let's talk about the markets, and we can talk about the stock market in general if you want. I've got some questions on interest rates. What are your thoughts on the markets? I mean, there's sectors obviously we think are very expensive, some of the technology sectors. On the other hand, they're still putting out fantastic growth numbers. So where do you think you are where do you think we are, from a cycle standpoint?
Sure. So when I look at the overall market, and we'll call the overall market the S&P 500 for now. When we look at the S&P 500, we think it looks overvalued today by almost any metric you can look at. And our metric we like to use, we use a capitalized profits model. And that shows us today that the market looks to be about 20% overvalued. Now, it's not a trading model. It's a model that is good at showing inflection points, I think, when the market's undervalued. If you took our model back to the late 90s, it showed 98, the market was overvalued. 99, the market was exceptionally overvalued. But over that period, the market obviously continued to grow substantially. Prices continued to grow substantially, even though the model said it was overvalued. So that's not to say that things can't continue to grow. But to us, it shows that we would not be just throwing money at the S&P 500 today. We think you do need to be more selective. I mean, just the way the S&P is built as a market cap weighted indice, those which we call the Magnificent Seven companies, those 7 biggest companies have really driven majority of the gains over the last couple of years. And if you haven't been market cap weight or overweight those areas, if you haven't been overweight those areas, you've underperformed. Well, now I think we're starting to see finally a broadening. And so you want to be at least equal weight in the S&P 500 or even favoring a lot of those smaller companies within the S&P 500, I think, moving forward here.
Yeah, I think that makes a lot of sense. And at Cottonwood, we think a lot of this along the same lines. I mean, valuations are stretched, and when you look at it from a totality basis, some of the smaller, even the smaller and mid-sized companies look a lot more attractive. So it's just hard to, kind of rest on the fact that we're going to have another 20% growth in the S&P like we've had the last 2 years. I just think that's tough. I think that's going to be a tough metric to hit.
I agree. And you look at the average analyst this year, they're looking at 10+% growth for the markets. And I think that's pretty optimistic for if it turns out that the economy is slowing and earnings don't meet expectations. I think it'll be very hard for the market to even get up 10% this year.
Yeah, I think that makes sense. Well, we're talking about tech a little bit, so let's talk about AI. What are you seeing with AI? Obviously, it's a hot topic, but as I kind of mentioned at the beginning, I think people get enamored with AI and all the possibilities and the outlook and the future. And excuse me. Obviously, there's a lot of investment dollars going at AI from a technology standpoint. How do you see that evolving over the next few years?
Yeah, I mean, I think when you look at where we are and where we're going, it's hard. I don't even think we'll be able to fathom where we'll be in the next 10 years. I think AI is real. It's going to be life-changing. It's going to cause massive productivity gains, and I think we're starting to see that already. But I think one of the reasons that the market's overvalued is people are enamored with AI, and especially these AI companies, and I think they've gotten too far ahead of themselves. Are they great companies? Sure. Are they putting off lots of profit? Sure. But I think the prices are a little rich for where things are today. So I think you'll be able to pick them up at better values in the future. Not to say they're not going to be around over the next 5 to 10 years or longer or really be companies that change the world. I think a lot of them will. But I think we're still in the very early stages. But the reality is that AI is not new. It's just really come to the forefront over the last couple of years. It's really first AI was really used 100 years ago, and it's just every year it's gotten better and better as chips have gotten faster and faster and cheaper. And I look at this, and I think one of the reasons the Mag 7 companies have done so well is that they've been heavy investors in artificial intelligence for 15, 20 years plus. I mean, a lot of their money has gone to that. I mean, think about a company. I always like to think about Netflix. You guys remember Netflix when, back in the early 2000s, and we get those little red envelopes in the mail with with the DVDs in it. Yeah. Those envelopes are amazing, right? They're indestructible. I don't know what they made those out of, but you do whatever you want. You couldn't just. But anyway, you'd get that in the mail, and then you'd watch the DVD, and there's a star system, and you'd say this is like 4 or 5, whatever it was, 4 or 5 stars. You rate it, and then they'd say based off your ratings, they built out their data and they built out their algorithms, and they said, okay, if you like this, then you're probably going to like this, and you'll like this, so on and so forth. And what's fascinating to me is, I mean, all Netflix was really a machine learning company by direct mail. That's what they did. They machine learned with direct mail, and they did that till about 2007, and the internet finally was able to handle, which is crazy to think about because we just watch media all the time now. But by 2007, they could finally do a online streaming platform, and they launched that in 2007, and then they started to get all this different data because they could get feedback even faster. They continued to build their algorithms, and their algorithms got so good that by 2011 they said, well, why? I mean, we've been this TV distributor and movie distributor for our whole existence. We have all the data. We know exactly what people want. Why don't we start producing? And so in that year, 2011, they went out into the market and started searching for a TV show. And that was the year House of Cards was being sent out. They were going out and meeting with all the big TV studios, and every studio loved the idea of House of Cards, but none of them would pick it up. And the reason they wouldn't pick it up was because House of Cards didn't have a pilot episode. And every studio said, well, how are you expecting us to, I mean, we like the idea, but we don't know if people are going to like this. We need to have a pilot episode so people can see it. And what's interesting is in 2012, that following year, there was 113 pilot episodes. It cost $400 million for those 113 pilot episodes.
Wow. Only
35 of them actually made it to air for a season. Wild to think about. Of that, only 13 of those 35 made it to a second season. So 1 in 9 of those pilots made it 2 seasons or more. $400 million. I mean, how inefficient.
That's not a good business model.
No, it's not. And that's how it's always done. And so Netflix came in and they went to House of Cards. I mean, nobody had done anything like this before. They said, hey, we'll pay you $100 million for 2 seasons up front. And they said, are you serious? Yeah. I mean, I can imagine all those TV producers from all these big studios sitting around saying, what are these guys doing? They're just blowing $100 million. No pilot? Are you serious? And sure enough, the show was produced and, it launched in 2013. This is the very first year. And in 2013, Netflix never produced anything, was number 10 for the amount of Emmy nominations they received out of everyone. Number 10. By 2018, Netflix has been either number 1 or number 2 every single year for Emmy nominations against every single major network. And that's the power of artificial intelligence and algorithms. And think about the productivity gains that Netflix has seen. Well, that's moving to almost every single industry across the board. It's not overnight, that's why I think the market's gotten ahead of itself. But when I look out over the next 5, 10, 15 plus years, the productivity gains we are going to see from all these technologies, I mean, it's exciting.
Yeah.
So I'd say in the short term, I'd be more cautious in the markets, but over the long term, I'm very excited.
Do you think that technology strider starts to broaden out to other companies and sectors and industries? Like you said, the Mag 7, maybe the reason they're as high as they are today is because they were ahead of the curve, right? So they were throwing a lot of investment in AI as a technology because they saw the writing on the wall. But do you think maybe that spreads out where some smaller companies, some startups and things like that could benefit?
Big time. Yeah, I think that's the real key over the next 10 to 15 years, 5, 10, 15 years, is that I don't think there's going to be really any sector where artificial intelligence doesn't play a massive role in the way that they do their business. And you think about the productivity gains that you see from that, the profit margin increases that we're going to experience. And a lot of people say, well, it's going to take a lot of jobs, which is true if you're just focusing on those jobs, but it's going to create so many more industries, which are going to create even more jobs. And I can't even tell you what those industries are today, but they're going to happen. And the world's going to be better because of it.
Yeah, I agree.
In a big way.
I agree with you. I mean, if you look through history, right, whether it's the Industrial Revolution with farming and automobile transportation, all these different sectors, if you look back 50 plus years, commanded the majority of our workforce, and now it doesn't. Yet the productivity, the jobs, the profitability and the benefit to societies are tremendous. And I personally think it's going to be the same case with AI. It's just difficult to see that right now because it's disruptive and it's different, and it scares people in some regards because it is different.
It's just the unknown, right? And you think about that a lot, right? But what's interesting today is if you think about where we are today and you think about your smartphone that you have in your hand and how it's indispensable to all of us today, where 15 years ago, very few of us had a smartphone or even would have dreamt of the way it would change our lives today. And if you knew how it was going to change your life, I mean, we can't even imagine living without it today.
Right.
And so the future is always scary. But I think 10 years from now, if we're sitting here doing this again 10 years from now, and we think about the way we're using AI in our lives and how it's made things just so much easier, so much more productive, we're going to think, well, how did we possibly ever live any other way besides the way we're living today? We get so comfortable with things so quickly, even though it seems scary maybe right now. But I think the future is really exciting. And not only that, but you think about the rate of change of these models and how fast things are going and the way we're able to process data like never before. The next 5 to 10 years, you think about medically the type of diseases that are going to be cured just purely because the data might already be out there. We just don't know how to process it. But now with artificial intelligence, as these models get bigger and bigger, I mean, we're going to be able to process it. It's so exciting to think about.
Yeah, there's a term I come back to a number of times, but with the rate of change, especially with technologies, things have never been as fast as they are today, and going forward will never be as slow as we are today. Right, the rate of change is going to increase in velocity and speed, and we're just going to have to figure out a way to embrace it.
Yeah,
right.
Exactly. We really are.
Yeah. Well, this has been really a fabulous conversation. Thank you for sharing some insights in the economy. I know we talked about the markets. I do want to, so we had some questions coming in from our listeners. I want to get to at least a couple of those if we have some time. Yep. So let me pull those up here. Sorry, guys, bear with me. I think this is a good question to kind of kick it off. So, Strider, what do you think will be or could be the biggest surprise in 2025?
That's a great question.
It's a broad question. I know.
It is. No,
you take it any way you like.
Yeah.
Or any direction. Excuse me.
I just think that people are pretty confident right now on the state of the economy, that things are going to continue to grow and stay very strong. And then with that, the state of the markets, that things are going to continue to grow and be strong. And I believe one of the biggest surprises of 2025 is that the Magnificent Seven that's driven the market for so long actually closes the year negative. That's going to be mine. Whether it happens or not, we'll find out. But I'm going to say that will be my biggest surprise, that it actually is negative for the year, not positive.
Do you, and I'm putting you on the spot a little bit, do you think that would be tech in general or maybe just the Mag 7?
I think, in general, I think we will see a market that struggles this year, just because I do believe we're going to see a slowdown and earnings aren't going to be they're not going to grow as fast as what many are expecting right now. So overall, tech could be down, but I think the Magnificent Seven would be obviously a big drag on that. But with that, if the Magnificent Seven did finish down for the year, I think there's a good chance that the market would finish down for the year as well.
Yeah, makes sense. It's another question we had coming in. I like this one. We at Cottonwood, we have a pretty intense focus on the private markets, alternatives as we call them, which is obviously a growing market. Different sectors and things have been democratized. With the growth in two areas in particular, venture capital and private equity, what impact do you think that's going to have on the market over the next, say, 2 to 3 years?
Yeah, I mean, we've seen kind of a slowdown a little bit on the venture side and really the private equity side. I think it will start to pick back up again, but that really got kind of one of the hot areas to really be in.
Right.
I think alternatives in general are a really good area to be in over the next 5 to 10 years, especially with how fast the overall stock market has been moving up. I think you'll be able to get a lot of excess return by being an alternative. So I look at it as an area that's going to continue to grow and continue to flourish. And I think really what's happened over the last couple of years, and I think what will really happen over the next 5 years, is that we're going to see the ability for more and more people to have access to those investments, to be able to get into private equity deals, to be able to get into venture deals. Over the last 20, it's been, if you don't have a certain income or a certain amount of net worth, it's been very hard to get into a lot of these deals that are run by the best fund managers. Well, a lot of that's starting to get democratized now, where you can put in lower amounts of money or whatnot to get into these areas. And so to me, that's really exciting. You have some of the best and brightest that are picking companies to be holding in these funds and whatnot that most don't really have the access to, that I think over the next 5 to 10 years, a lot of people will start to have access to those.
Yeah, that makes a lot of sense. So even though venture and private equity, for example, have kind of run up, maybe got a little hot the last couple of years.
Yeah.
Just given those trends you're talking about, that's very likely. You think those areas will probably be okay, right?
I think so, yeah. Oh, definitely long term. Yeah, I think just like the stock market as well. I think there's a lot of, and it depends obviously where you are in alternatives. I think there's a lot of alternatives that you can get into today that really have very little correlation with the S&P 500. But those areas that do have a lot of correlation with the stock market, I think they've all gotten a little bit overheated here. But are they companies that they're investing in that they think are going to continue to do well or be able to survive a downturn and thrive in the future? I definitely believe so for a lot of these. So I think it's an area that you're going to want to continue to pursue and use as a diversification away from the stock market as well.
Yeah, it's those non-correlated assets. They're hard to find.
They are.
They're really hard to
find.
They
are, especially today.
Yeah. Yeah. We have one last question. This is a little bit different topic.
Sure.
Where do you see taxes heading in the next, pick your time frame. Let's just say the next year or so.
Sure. Yeah, I don't see them heading up at all. And I think that's what's really key. I think we'll see taxes continue lower across the board. I think President Trump is really going to push for further tax cuts. And I look at that as a huge benefit to the economy. If they are able to cut spending and they're able to cut taxes, I think that'll be a huge boost to the economy. Overnight, I think really a lot of the policies that President Trump is putting forth are going to be very, 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 very beneficial to the economy over the long term. But in the short term, some of them may cause some short-term pain. So I think especially if we cut government spending to some degree, we've been just addicted to it over the last, forever, really. If we're able to cut some of that government spending, in the short term, that's pain. But in the long term, we'll have such a more vibrant private sector. That's going to be a huge benefit. If we're able to see further tax cuts, that's a huge benefit to the private sector as well. I think it will drive more business creation, more growth. People will be able to keep more of their money. That to me is a huge benefit to the economy as well. So all that to say, I think we'll see further tax cuts. I would be very surprised if we see any tax hikes moving forward here over the next couple of years. I just don't see that as likely, nor do I think we need them. Revenues are coming in, as I said, at their historical average, right around 17.5% of GDP.
Yeah. Well, hey, this has been a great conversation. Thank you
real,
so much
for
taking the time with us at Pocket Pundits. I know our listeners are going to get a lot of great insights. And again, as I kind of mentioned earlier, you guys, First Trust has been a great partner of ours. And I feel like, you guys are leaning into some of the different ideas, some of the contrarian viewpoints, but obviously backed up with facts, data, trends, and what's going on in the market. So I know it's super valuable for our listeners. And again, thanks again, Strider, for,
thank you.
for spending the time with me.
It's been a real pleasure to be with you.
Yeah.
Thanks, Matt.
Thanks, everybody. And we'll see you next time.